Question 1. What is the primary purpose of a life insurance policy? A. To provide income during retirement. B. To accumulate a cash value for future expenses. C. To protect against financial loss due to premature death. D. To cover medical expenses in old age. Answer: C. To protect against financial loss due to premature death. The core function of life insurance is to provide financial protection to beneficiaries upon the premature death of the insured. This means that if the insured dies unexpectedly, the death benefit pays out to chosen individuals or entities, helping them maintain financial stability and meet obligations like mortgage payments or daily living expenses. While some policies build cash value or can be part of retirement planning, their fundamental role is to mitigate the financial risk associated with an untimely death. Remember, life insurance is primarily about protecting survivors from the economic consequences of a loss of life. Question 2. If an applicant for life insurance misstates their age on the application and it is discovered after their death, what will the insurer typically do? A. Deny the claim. B. Refund the premiums paid. C. Adjust the death benefit to what the premiums would have purchased at the correct age. D. Pay the full death benefit as originally stated. Answer: C. Adjust the death benefit to what the premiums would have purchased at the correct age. The misstatement of age or gender provision allows the insurer to adjust the death benefit rather than voiding the policy entirely if the insured's age or gender was misstated. The insurer will pay the amount of insurance that the premium paid would have purchased at the correct age or gender. This provision ensures fairness, as age and gender are critical factors in determining premium rates and underwriting risk. Understanding this provision is crucial because it ensures that errors don't necessarily negate coverage but lead to a proportional adjustment. Question 3. After a life insurance policy has been in force for 2 years, the Incontestability Clause prevents the insurer from A. Increasing the premium. B. Denying a claim due to misstatements on the application. C. Changing the beneficiary designation. D. Reducing the death benefit. Answer: B. Denying a claim due to misstatements on the application. The Incontestability Clause is a crucial policy provision that protects the policy owner from potential rescission by the insurer after a certain period, typically 2 years. This means that once the 2-year period has passed, the insurer cannot deny a claim based on misstatements, concealment, or fraud in the original application, even if they later discover inaccuracies. The clause ensures that beneficiaries receive the death benefit without endless investigation into the application's accuracy, providing certainty and peace of mind. This provision encourages insurers to conduct thorough underwriting initially rather than denying claims years later. Question 4. What is the primary purpose of a life insurance policy's grace period? A. Allow the insurer to review the policyholder's health. B. Provide extra time for premium payment before the policy lapses. C. Enable the policyholder to surrender the policy for its cash value. D. Permit a change in beneficiary designation. Answer: B. Provide extra time for premium payment before the policy lapses. The grace period is a stipulated time, usually 30 or 31 days, during which an overdue premium can be paid without the policy lapsing. If the insured dies during this period, the death benefit is still payable, though any unpaid premium is typically deducted from the proceeds. This provision offers a safety net for policy owners who might be temporarily delayed in making a payment, preventing an immediate loss of coverage. It's an important safeguard, ensuring that a minor delay doesn't result in complete policy forfeiture. Question 5. The waiver of premium rider in a life insurance policy typically applies if the insured becomes A. Unemployed. B. Totally and permanently disabled. C. Seriously ill, but still able to work. D. Terminally ill with less than 6 months to live. Answer: B. Totally and permanently disabled. The waiver of premium rider is an optional add-on that, if purchased, will pay the premiums for the insured's policy if they become totally and permanently disabled. This ensures that the policy remains in force and provides coverage even when the insured is unable to work and earn income. The benefit usually kicks in after a waiting period, typically 6 months, and continues as long as the disability lasts, preventing the policy from lapsing. It's a valuable rider for protecting coverage during a severe unforeseen event. Question 6. If an insured commits suicide within the first 2 years of a life insurance policy, what is typically the insurer's liability? A. The full death benefit is paid. B. The policy is voided, and no benefits are paid. C. The premiums paid are refunded. D. Only 50% of the death benefit is paid. Answer: C. The premiums paid are refunded. The suicide clause in a life insurance policy typically states that if the insured commits suicide within a specified period, usually 2 years from the policy's issue date, the insurer's liability is limited to a refund of the premiums paid. This clause is designed to prevent individuals from purchasing a policy with the immediate intent of committing suicide to provide a death benefit. After this initial period, if suicide occurs, the full death benefit would usually be paid. This helps maintain the integrity of the insurance contract by discouraging fraudulent actions. Question 7. What is a characteristic of term life insurance? A. It builds cash value. B. It provides coverage for the insured's entire life. C. It provides coverage for a specific period of time. D. Premiums remain level throughout the life of the policy. Answer: C. It provides coverage for a specific period of time. Term life insurance is known for providing coverage for a defined period, or term, such as 10, 20, or 30 years. Unlike permanent life insurance, it does not accumulate cash value and only pays a death benefit if the insured dies within that specific term. It is often the most affordable type of life insurance initially because it offers pure protection without the savings component. This makes it a popular choice for temporary needs, like covering a mortgage or providing for young children until they are grown. Question 8. Which feature is unique to whole life insurance? A. Flexible premiums. B. Coverage for a specified term. C. Guaranteed cash value accumulation. D. Policy owner directs investment choices. Answer: C. Guaranteed cash value accumulation. Whole life insurance is a type of permanent life insurance characterized by level premiums, guaranteed lifetime coverage, as long as premiums are paid, and a guaranteed cash value component. This cash value grows at a guaranteed rate and can be accessed by the policy owner through loans or withdrawals. Unlike other permanent policies like variable life, the growth of the cash value is not subject to market fluctuations, providing a predictable savings component. This feature makes it distinct from term insurance and other permanent policies that involve investment risk. Question 9. A key feature of universal life insurance is its A. Fixed premium and fixed death benefit. B. Investment component managed by the policy owner. C. Flexible premiums and adjustable death benefit. D. Pure protection without a cash value component. Answer: C. Flexible premiums and adjustable death benefit. Universal life insurance is a type of flexible permanent life insurance that allows policy owners to adjust their premium payments and death benefit amount within certain limits. It features a cash value component that earns interest, and a portion of each premium goes towards the cost of insurance and policy expenses, with the remainder contributing to the cash value. This flexibility distinguishes it from traditional whole life insurance, which has fixed premiums and a fixed death benefit. Universal life offers adaptability, allowing the policy to evolve with changing financial needs. Question 10. Which statement about variable life insurance is correct? A. Its cash value growth is guaranteed. B. The policy owner bears the investment risk. C. It does not require a securities license to sell. D. Its death benefit is fixed and unchanging. Answer: B. The policy owner bears the investment risk. Variable life insurance is a type of permanent life insurance where the cash value is invested in a separate account, often in sub-accounts chosen by the policy owner, similar to mutual funds. Because the cash value and potentially the death benefit fluctuate based on the performance of these investments, the policy owner assumes the investment risk. This means the cash value can grow significantly but can also decrease, and sellers must hold a securities license in addition to a life insurance license due to the investment component. It offers potential for higher returns but with greater risk. Question 11. Which life insurance policy provision prevents a policy from lapsing due to an unpaid premium by borrowing from the policy's cash value? A. Grace period. B. Reinstatement provision. C. Automatic premium loan. D. Non-forfeiture option. Answer: C. Automatic premium loan. The automatic premium loan provision is a policy rider that, if elected by the policy owner, automatically pays an overdue premium by taking a loan from the policy's cash value. This prevents the policy from lapsing if the premium is not paid by the end of the grace period. While the loan accrues interest and reduces the death benefit if not repaid, it ensures the policy remains in force during a time of financial oversight or difficulty. This provision is a valuable safeguard against unintentional policy lapse. Question 12. If a policy owner decides to surrender their whole life policy and take a reduced amount of paid-up insurance, they are utilizing which non-forfeiture option? A. Cash surrender value. B. Extended term option. C. Reduced paid-up insurance. D. Interest-only option. Answer: C. Reduced paid-up insurance. Non-forfeiture options are choices available to a policy owner if they stop paying premiums on a permanent life insurance policy with cash value. The reduced paid-up insurance option uses the existing cash value as a single premium to purchase a new, fully paid-up policy for a reduced face amount. The coverage continues for the insured's lifetime, but for a smaller death benefit. This option provides ongoing, albeit reduced, coverage without further premium payments. Question 13. When a beneficiary chooses to receive life insurance death benefits in equal installments over a specified number of years, they have selected which settlement option? A. Lump sum. B. Interest only. C. Fixed period. D. Fixed amount. Answer: C. Fixed period. Settlement options dictate how the death benefit from a life insurance policy is paid to the beneficiary. The fixed period option involves the death benefit, including any interest earned, being paid out in equal installments over a predetermined number of years. This provides a steady income stream for a specific duration, which can be useful for beneficiaries needing income for a set time frame, like covering educational expenses. It offers a structured way to receive the benefit, ensuring predictable payments for a limited time. Question 14. A policy owner assigns a life insurance policy to a bank as security for a loan. This is an example of A. Absolute assignment. B. Collateral assignment. C. Revocable assignment. D. Viatical settlement. Answer: B. Collateral assignment. A collateral assignment of a life insurance policy means the policy is temporarily assigned to a creditor as security for a debt. The policy owner retains full ownership rights to the policy, except that the creditor, assignee, has rights to the death benefit up to the amount of the outstanding loan if the insured dies. Once the loan is repaid, the assignment is released, and the policy owner's full rights are restored. This differs from an absolute assignment, where all rights of ownership are permanently transferred. Question 15. What is the purpose of the free look provision in a life insurance policy? A. To allow the insurer to review the policyholder's financial health. B. To give the policy owner a period to return the policy for a full refund. C. To enable the policy owner to make changes to the policy without charge. D. To allow the insurer to adjust premiums after policy issuance. Answer: B. To give the policy owner a period to return the policy for a full refund. The free look provision, also known as the right to examine period, allows a new policy owner to review the policy after delivery for a specified number of days, usually 10 or 20 days. If the policy owner decides for any reason that the policy is not suitable, they can return it to the insurer within this period and receive a full refund of all premiums paid. This provision ensures consumer protection by giving ample time to confirm the policy meets their needs without financial penalty. It's essentially a no-questions-asked return policy for insurance. Question 16. A distinguishing characteristic of group life insurance compared to individual life insurance is that A. Group policies typically build significant cash value. B. Individual members usually receive a policy document instead of a certificate of insurance. C. The group sponsor, employer, is the policy owner, not the individual member. D. Medical examinations are always required for group coverage. Answer: C. The group sponsor, employer, is the policy owner, not the individual member. In group life insurance, the employer or another group sponsor holds the master policy, making them the policy owner. Individual members of the group, such as employees, receive a certificate of insurance as proof of coverage, not the actual policy itself. Group insurance often provides coverage to members without requiring individual medical examinations, and it generally does not build cash value like most individual permanent life policies. This structure simplifies administration and often makes coverage more accessible and affordable for employees. Question 17. The primary purpose of key person life insurance is to A. Provide retirement benefits for key employees. B. Protect a business from financial loss due to the death of a vital employee. C. Fund an employee's personal life insurance needs. D. Cover medical expenses for key executives. Answer: B. Protect a business from financial loss due to the death of a vital employee. Key person life insurance is purchased by a business on the life of an employee whose unique skills, knowledge, or leadership contribute significantly to the company's success. The business is both the policy owner and the beneficiary. If the key person dies, the death benefit helps the business recover from the financial impact of their loss, covering costs like recruiting a replacement, lost revenue, or outstanding debts. It's a risk management tool specifically designed to safeguard business continuity. Question 18. A business uses a buy-sell agreement funded by life insurance to A. Provide life insurance coverage for all employees. B. Ensure a smooth transfer of business ownership upon the death of an owner. C. Fund employee benefit plans. D. Pay off outstanding business debts. Answer: B. Ensure a smooth transfer of business ownership upon the death of an owner. A buy-sell agreement is a legal contract that determines how a partner's or shareholder's share of a business will be reapportioned if that person dies or otherwise leaves the business. When funded by life insurance, if an owner dies, the death benefit provides the necessary funds to the surviving owners, or the business itself, to purchase the deceased owner's interest from their heirs. This ensures business continuity, prevents outside interference, and provides liquidity for the deceased owner's estate. It's a critical tool for business succession planning. Question 19. Generally, the death benefit paid to a beneficiary from a life insurance policy is A. Taxable as ordinary income. B. Taxable as a capital gain. C. Received income tax-free. D. Taxable if the beneficiary is not a family member. Answer: C. Received income tax-free. One of the most significant advantages of life insurance is that the death benefit paid to a named beneficiary is generally received income tax-free at the federal level. This means the full face amount of the policy is available to the beneficiaries without being reduced by income taxes. While state laws can vary, this tax-free aspect makes life insurance an extremely efficient tool for transferring wealth and providing financial security. Remember this key benefit when explaining life insurance to clients. Question 20. If a policy owner takes a loan from their life insurance policy's cash value, how is this loan typically treated for tax purposes? A. It is taxable income up to the amount of the gain. B. It is tax-free, as it is considered a loan, not a withdrawal. C. It is taxable only if the policy lapses with the loan outstanding. D. It is considered a capital gain. Answer: B. It is tax-free, as it is considered a loan, not a withdrawal. Policy loans taken from the cash value of a life insurance policy are generally not considered taxable income because they are treated as debt against the policy, not a distribution of gains. Interest accrues on the loan, and any outstanding loan balance will reduce the death benefit payable if the insured dies. However, if the policy lapses or is surrendered with a loan outstanding, the amount of the loan, to the extent it exceeds premiums paid, could become taxable. This feature allows policy owners to access their cash value without immediate tax consequences. Question 21. Stranger-originated life insurance, STOLI, arrangements are generally considered illegal or unethical because they A. Are sold without a valid insurance license. B. Involve no insurable interest at the time the policy is issued. C. Are used primarily for money laundering. D. Exclusively target individuals with poor health. Answer: B. Involve no insurable interest at the time the policy is issued. Stranger-originated life insurance, STOLI, also known as investor-originated life insurance, IOLI, involves a third party, often an investor, initiating a life insurance policy on someone else's life solely to profit from the death benefit. The crucial issue is that the third party lacks an insurable interest in the insured's life at the policy's inception, meaning they would not suffer a financial loss upon the insured's death. State laws require insurable interest at the time of policy issuance to prevent wagering on human lives and are a fundamental principle of insurance law, making STOLI arrangements illegal or against public policy. Question 22. To reinstate a lapsed life insurance policy, the insured generally must A. Submit a new application and undergo a new medical exam. B. Pay all back premiums with interest and prove insurability. C. Wait for the original policy term to expire. D. Provide a written statement of good health and pay one missed premium. Answer: B. Pay all back premiums with interest and prove insurability. The reinstatement provision allows a policy owner to restore a lapsed policy to its original status, typically within a certain period, e.g., 3 to 5 years, after lapse. To reinstate, the policy owner must generally pay all back premiums with interest, repay any outstanding loans with interest, and provide satisfactory evidence of insurability, such as a statement of good health or a medical exam. This provision is beneficial as it allows the policy owner to reactivate their original policy, often retaining its original issue age and policy provisions. Question 23. The accidental death benefit rider, often called double indemnity, typically pays A. A benefit if the insured dies due to an illness. B. Double the face amount of the policy if death results directly from an accident. C. Coverage for accidents that occur on the job. D. A refund of all premiums paid if death is accidental. Answer: B. Double the face amount of the policy if death results directly from an accident. The accidental death benefit rider, commonly referred to as double indemnity, is an optional rider that provides an additional death benefit if the insured's death is a direct result of an accident and occurs within a specified time frame, e.g., 90 days, of the accident. This means the policy will pay the standard death benefit plus an additional amount, often doubling or tripling the face amount, if the cause of death is accidental. It offers enhanced protection specifically for unforeseen accidental fatalities. Question 24. Which of the following is true regarding insurable interest in a life insurance policy? A. It must exist only at the time of the insured's death. B. It must exist only at the time of policy issuance. C. It must exist for the entire duration the policy is in force. D. It is not required if the beneficiary is a family member. Answer: B. It must exist only at the time of policy issuance. For a life insurance policy to be valid, insurable interest must exist between the policy owner and the insured at the time the policy is issued. Insurable interest means there would be a legitimate financial or emotional loss if the insured died. Once the policy is in force, the insurable interest does not need to continue for the policy to remain valid. This principle prevents individuals from profiting from the death of strangers and ensures that policies are purchased for legitimate protective purposes. Question 25. An individual covered by a group life insurance plan who leaves their employment typically has the option to A. Transfer their group coverage to another employer's group plan. B. Convert their group coverage to an individual policy without proving insurability. C. Continue their group coverage indefinitely by paying the group premium. D. Receive a cash value payout from their group policy. Answer: B. Convert their group coverage to an individual policy without proving insurability. A key feature of group life insurance is the conversion privilege, which allows an employee who leaves the group, e.g., due to termination or retirement, to convert their group coverage into an individual permanent life insurance policy. This conversion must typically be done within a specific time frame, e.g., 31 days, without requiring evidence of insurability, meaning they don't have to pass a medical exam. This is a significant benefit, as it ensures continued coverage even if the individual's health has deteriorated since initially joining the group plan.